Good afternoon, everyone. Thank you very much for joining us today. My name is Patrick Ray. I am one of the retirement advisors here with the Retirement Group, and we appreciate you spending a few minutes of your day today with us. We have some wonderful information to bring to you. And before I bring on today's speaker to talk about what we have to discuss for you ConocoPhillips folks, first and foremost, it's important for you to know we have no affiliation with ConocoPhillips in general. And in fact, we have no affiliation with Fidelity. We are a completely independent financial planning and retirement planning organization, and our experience comes with the people that we've met with who are in similar positions as yours, who are trying to transition into a successful retirement. And one of the tools we utilize to help people with the education process of all the things that we have to talk about with folks is this webinar platform. And so hopefully you'll get some value out of what we have to discuss today, talking about interest rates and the pension plan and et cetera. But we'll also have some additional material that you can access via the links that are dropped into chat. So there's a link that you can see some of the recordings that we've done in the past, because usually about a week after we record these, we post them for you to view at your own leisure. So we encourage you to check those out. And there'll also be a link in there to the eBooks library, which is access to a bunch of great short to read material on some of the most common questions that we get on a very regular basis. But finally, what you may find the most value of is spending a few minutes with us to generate something called a cash flow analysis. This is where we spend a few minutes with you and learn about your objectives and your goals and try to help you see if you're on track to meet those through a very detailed analysis that we do on a complimentary basis. And so we'll give you some ways to get a hold of us towards the end of the workshop today in the event that you wish to take advantage of that. If it's been a number of months or years since you've had one done, if we've done one in the past for you, or if you haven't yet experienced that, we'd love to get a chance to do that for you. Lastly, if you have questions about what we're having discussions about today or anything in specific about ConocoPhillips, please feel free to drop those questions into the question and answer box, and we'll do our very best to get to those at the very end of our webinar today. So with that, what I'd like to do is bring on my partner to talk about today's material. Tyson?
Thank you, Patrick. Thank you, folks, for attending our webinar series this afternoon. My name is Tyson Mavar, one of the ConocoPhillips focused retirement advisors for the Retirement Group here in Texas. And here we are approaching the end of the first quarter of 2022. And as it turns out, we are now seeing what we've been waiting for some time to see what's going to happen to the pension plans for ConocoPhillips employees as it pertains to the interest rates that affect the lump sums. We're going to talk in detail about those interest rates today, as well as how they apply to the various different pension plans, as there are many, as many of you know, depending on where and when you started your career with the company. So those of you who aren't as familiar with our company, the Retirement Group is an independent financial planning organization. We manage retirement assets for corporate employees and have many clients from ConocoPhillips that we have developed retirement plans for and earned the business of over the last close to 30 years that we've been in business. Our hope is that you utilize the resources that we have available to you and that you don't make any decisions without first understanding all of the long-term implications of the decision-making process that you have to go through as you approach retirement from ConocoPhillips and then ultimately after you leave the company. And there's a whole host of different complementary services we have available to ConocoPhillips employees, both retired and active. And our hope is that if you decide to work with an advisory group, that you consider our company as one of the companies that is on your retirement team after you leave the company to help you maximize your retirement income, minimize your taxes, and have the most comfortable retirement possible after you leave the company. Now, like I mentioned earlier, there's quite a few pension plans, and this is why it helps to have a one-on-one conversation with one of our ConocoPhillips focused advisors who understands the various ins and outs of these plans, because each one works differently, each one grows differently, each one has different implications of interest rates on the lump sum, different distribution options. So first, it's important to understand which plan you're on, then understand the details of that plan, and then build the pension plan into your overall retirement plan, which is what we do in the cash flow analysis that Patrick mentioned earlier. Now, the plans that we run into most with our clients and people that we've met with over the years are the Title I, it's a Phillips Retirement Income Plan. Title II, which is a newer plan that came out after the merger back. This plan came out in 2003, the ConocoPhillips Cash Balance Account. And Title IV, the Retirement Plan of Conoco. We also have some clients from Burlington who have a similar plan to the Phillips Heritage Plan, but each one of these works a little bit differently and has important considerations as you approach your transition from the company that could help you with the timing of your retirement and also which plan might be most appropriate for you and your family. So I encourage everybody to spend 10, 15 minutes with us just to understand your plans a little bit better and talk about some of these important interest rate implications. If there's any possibility, you may consider the lump sum option on your pension. And even if you're considering the annuity option, if you're on a cash balance pension plan, the interest rates also affect that. So spend some time with us. We're delighted to spend a few minutes with you if you can make some time, and we're very confident it's going to be a good investment of your time. Now, as it turns out, there's 3 primary distribution options of the pension plan for ConocoPhillips. The straight life annuity, also known as the single life annuity. This is a monthly payment for the rest of your life, you the employee, and your life only. We also have a joint survivor annuity with a variety of different survivor options. The survivor options are essentially how much you are willing to give your joint survivor, whether it's a spouse or somebody else, and are willing to give up during your lifetime as a result, because there is a trade-off there that you're going to get less income during your lifetime in an effort to give more income to somebody else, typically a spouse, but not always. And then what is currently, I would say, the most popular option, given the unprecedentedly low interest rate environment that we're in today, is the lump sum option. Now, unfortunately, it's all or nothing with these options. We have clients also from ExxonMobil where the company allows them to take a hybrid option, some annuity and some lump sum. That is not the case with ConocoPhillips. You have to either take the full lump sum, and maybe if you're interested in guaranteed or some form of lifetime income after you leave the company, use a portion of that lump sum maybe to purchase your own private annuity. But you can't take a portion of both of these options. You have to take all of one of these 3 options. And right now the lump sum is very attractive, but it's not appropriate for everybody. So this is another thing that we look to focus on when we run the cash flow analysis, is first understanding what values are important to you and your family, looking at things such as longevity, your risk tolerance, other assets and resources you have in retirement, and building a plan based on all of the various different resources you'll have to produce the cash flow you need. And to, with the highest degree of certainty, we don't always get it right because we can't predict the future, but with the highest degree of certainty, have the best and most optimal plan possible. Now, as many of you know, the lump sum is highly impacted by interest rates. And the interest rates that affect your plan depend on when you started at the company and what heritage company you came from or what pension plan you're on. I'm going to zoom in here so we can look at these a little bit deeper. What we're looking at here are the interest rates that get published and are effective on a quarterly basis. So as you can see on top here, December of 2021 predicts the interest rates that are used for lump sum recipients in Q2 of 2022. And that's the most recent official data we have as of today. The first, second, and third segment rates are based on short, intermediate, and long-term corporate bond interest rates. And those affect the lump sums for people that are on the defined benefit plans, but for their service that was after 2008. Now, if you worked for the company prior to 2008 and have one of these heritage defined benefit plans, you're also going to use at the very least the 30-year treasury rate and possibly the PBGC rate if you are a heritage Conoco employee. So we don't have that listed here, but that is currently 0%. And these interest rates, the higher they are, the lower the payout on your lump sum. Typically to the tune of about a 10% increase in your lump sum for every 1% drop in the interest rates. But what we're more concerned about going forward is the negative impact that a rising interest rate environment is going to have on the lump sum recipients of people that are either still working at the company or who decided to leave the company but left their pension at the company for a variety of different reasons. You might consider that, one being the age penalties if you take your pension prior to age 60. And another one being, we've had some clients that left and saw interest rates going down for several quarters. And that could be advisable to leave your pension in the plan because effectively we know that the rates are going down. We know your lump sum's going up. It's effectively a guaranteed increase to your lump sum in most cases. So there's several reasons you may want to keep your pension in the plan after you leave the company. But some of the risks of doing so are A, a rising interest rate environment eroding your lump sum, and B, the opportunity cost of not earning interest on that money, which you otherwise might be able to had you rolled that lump sum over to an IRA, for instance. So we know the second quarter lump sum recipients' interest rates here. You can see the 30-year Treasury is quite a bit lower than what is the most important of these segment rates, which is the second segment rate. It carries the most weight of these three corporate bond interest rates. For instance, it's 3 times more relevant than the first segment rate. So the second segment rate we pay a lot of attention to. The 30-year Treasury rate we pay attention to for folks that have service prior to 2008. And look what's happened. If you go back to December of 2020, at the bottom of this table, just over a year ago, interest rates have gone up almost 50 basis points, almost 0.5% since the end of 2020. And what that means to you in plain English, because like we mentioned earlier, every 1% increase to rates is about a 10% drop depending on your age, which is a function of the life expectancy portion of the calculation. That could be about a 5% drop in your lump sum in that year, at least as it pertains to these interest rates going up. Now, you probably gained some money in your pension because of additional years of service with the company. If you got some salary increases over time, that would also help your pension accrual. But these lump sums are very sensitive to these interest rate movements. And what we look at, if you look at the bottom of this slide here, the quarter 3 2022 interest rates, which will be based off of March, which is almost over, but the rates of which have not been published yet. So we looked to February to see where March may be going. And February's interest rates were published about 2 weeks ago. You can see that the second segment rate at 3.35 in February is already more than 60 basis points, more than 0.6% higher than the rates that were used for second quarter retirees that were based off of December. So we could be looking at close to 5 to 6% drops in lump sum payments going into the third quarter. The takeaway here is that if you are close to retirement, it is important that you rerun your numbers and consider leaving the company. We have a lot of clients that left the company primarily based on these interest rates. And even if they weren't ready to be done working, they locked in a high lump sum in a low interest rate environment, reinvested that money, and just went back to work on a part-time or full-time basis somewhere else as they transitioned into retirement and got the most out of this benefit plan. Now, if you're not close to retirement, this may not be a possibility. And also, if you're not close to retirement, you may need to consider some changes to your plan, given that you may have less money than originally anticipated in your retirement plan because of a lower lump sum payout. It may mean that you might start considering the annuity option or put more weight on that possibility as interest rates start going up. Or it might mean that you may want to consider saving more now, maybe cutting some things out of the budget or spending less in retirement, or maybe even working longer because of the likelihood that your lump sum payment is not going to be as much in the future as it was the last time you ran a future projection on what that lump sum was going to be 2, 3, 5 years down the road. So we spent a lot of time on this, but again, there's so many different plans and everybody's situation is so much different because of all the changes the company's gone through in the last several decades that it's important to understand the implications of your pension plan on your overall retirement plan. And that's why we spend so much focus at the retirement group, understanding these plans, understanding the changes that the company's gone through over the years so that we can tailor a plan specifically to each individual we talk to. And if at the end of the day, we earn your business, great. If not, no big deal, because we're pretty confident that you'll at least have good things to say about us to some of your coworkers who may also be interested in doing some business with us. Now, unfortunately, 74% of Americans statistically, 74% of Americans over the age of 50 do not have a written plan for their retirement. This is not acceptable, folks. You should have a written plan for your retirement before the age of 50. And if you don't yet, the good news is we're willing to do one for you on a complimentary basis. Usually takes about 15-minute phone call to gather the numbers that we need to run the plan, and typically a 30-minute to an hour-long conversation, whether web meeting, phone call, in-person meeting to go over the plan with you and start to get an understanding of what's important to you, what your objectives are, what your concerns are, and start to build upon what is currently what you have so that you can, when you leave the company, have the most money possible, have the least tax implications possible, be considerate of the distribution strategy and where your cash flow is coming from throughout retirement so that you can keep as much of your money as possible and first and foremost, not run out of money in retirement, which is most people's primary objective, at least, is making sure they don't outlive their assets. So take advantage of this if you haven't done so yet, or if it's been over a year since we've updated your plan, whether or not you're a client of ours, call us or let us know so that we can update this and maybe pivot on what was originally our plan, as we now have a different economy that we're in, some likely tax law changes that are coming up. And we just want to make sure that we stay dynamic with these plans when we put them together, because we can't predict the future. And when your retirement's going to be maybe 30 to 40 years long, that's a lot of guesswork that we're doing. So keep updating this continually, and whoever you work with, whether it's us or some other one of our peers in the industry, make sure that you're communicating with your advisor in retirement frequently so you can keep up with the changes that are constantly coming at us. If you have not had one of these plans written for you and you would like to do so, or if it's been a while since we've updated yours, or if you just like to review the 401k plan and see if there's any suggestions that we might have from a tax efficiency standpoint or from an investment standpoint, you can reach us at our home office at 800-900-5867. You can email us at info@theretirementgroup.com, or you can even take a picture of the QR code at the bottom left here and get on the calendar of one of our ConocoPhillips focused advisors just to spend a few minutes to make sure that there's not something that you should be doing that you're not already doing, or something that you are doing that you shouldn't be doing as you approach retirement, and make sure that haven't left anything on the table or left anything without considering before you approach your retirement, before you decide to make that leap from employee at ConocoPhillips to comfortable retiree. Also, here's a QR code to our LinkedIn page. This is where we publish these videos that we do live and record them so that you can peruse them at your own leisure, look at different topics that are interesting to you. We talk about different tax strategies for retirement, other benefits plans from ConocoPhillips. Estate planning is pretty important and pretty popular to many of the people that we talk to. So follow us there if you're not doing so already, or just give us a call and let us know what you're interested in learning more about, and we'll do our best to get you the resources that you need to have a successful retirement. With that, we are going to open it up for questions, but I thank everybody for joining us this afternoon. I hope to talk to you all soon. And Patrick, I'll pass it back to you for any last minute housekeeping issues or any questions if any came up.
Yeah, thanks, Tyson. We do have a number of questions, and so let's get right to it. Okay, one of the questions that came through was a understanding of the difference between the Conoco plan and the Phillips plan. And so this person would like to just talk for a second about the Phillips plan itself, the interest rates, and what makes them eligible.
Sure. So on the Phillips plan, the Heritage Phillips Title I of the 8 different titles, the lump sum is calculated differently than all other titles or all other pension plans. They're going to use the corporate bond interest rates to calculate your lump sum based on your service after 2008. And they're going to use the 30-year Treasury interest rate, which I didn't mention this earlier, but that is also up about 50 basis points or 0.5% from the December rate. So we're probably going to see close to 5% drops in that side of the lump sum calculation for both the Conoco and the Phillips and also the Burlington folks. The main difference, though, is that they do not use the PBGC rate for any of your service as a Phillips employee, as they do with the Conoco folks. So, if you started in 1980, a big portion, probably the vast majority of your pension lump sum calculation is based on the 30-year Treasury rate, which is a benefit because that's a lower rate in the aggregate compared to the corporate bond interest rates. But all those interest rates don't always move in sync with one another. They're not perfectly correlated. And we saw a couple quarters ago where corporate bond interest rates were going up, but the Treasury was flat. And there's even times when Treasury rates are going down while corporate bond interest rates are going up. So it's good to pay attention to all of the rates. And it's also very helpful to have the tool that you have through the Fidelity website to run your pension projections and make different assumptions about future interest rates. You can model different corporate bond interest rates, different treasury interest rates, different PBGC rates if you have them, which you probably don't, since it appears that you are a Phillips Heritage employee. But the main thing is just to run an analysis, look at different both timing of your retirement as well as interest rate assumptions on your retirement. And that'll help you not only pick the best day to leave, but also do what you need to do now to have enough money to leave whenever the time comes. And, we've seen this in the past. The company's had massive success with rising oil prices recently, but, many people have gone through different layoffs in the past that we don't always get to choose our retirement date, unfortunately. So getting prepared ahead of time in case that's you, in case you don't get to pick the time that you leave, is also something that I think is worth considering. So hopefully that answered that question. Do we have any more questions, Patrick?
We do. Yes, we do. Looks like there's a little confusion on, of course, the number of plans, which is, as you know, pretty common. And this person was talking about coworkers having the old plan versus the new plan. And the question is, do I get both? Do I get the better of which of these plans? How do the two plans kind of correlate to an individual that may be eligible for both of those?
Yeah, it's possible that you could have two plans. Back when the merger happened, the company, interestingly enough, gave employees an option to switch over to the cash balance plan, and they sold the heck out of it because it was more portable. You didn't have these age and service criteria to meet, but unfortunately, it wasn't as lucrative or beneficial of a plan, the cash balance plan. So if you did choose to switch over to it, you will likely have two pension plans. And it's also possible, I have a lot of Burlington people that I've met with over the years that have both a cash balance and a defined benefit plan. So these plans work differently, and it's good to know how both of them are different. It'll help you with the understanding the interest rates on the lump sum, as well as the timing of your retirement. Most employees just have one plan, and the defined benefit, the old Heritage plan being the better of the two plans compared to the cash balance plan. But they work quite a bit differently. And in fact, rising interest rates are actually helpful to the cash balance plan, whereas we learned today that they are hurtful to the old defined benefit plans. They actually reduce your lump sum payout. But they're both a little bit different. And I would encourage that person, if you have two plans, call us. And as it turns out, you could take the plans in different methods. And that might also be something to consider, is having both a lump sum and an annuity option on your pension plan to hedge the risk of both an uncertain future stock market as well as uncertain life expectancy. Those are some of the things that we're trying to guess at, but aren't always easy to. So hedging our bets and getting the best of both worlds might not be a bad idea to consider as well.
Yeah, and we have like two or three different questions that are all getting to the same thing, which is the rates going up and how they apply. And so this specific question we'll address, I guess, is I'm a Conoco employee for 17 years and confused about this interest rate discussion. And Mr. Mayvar mentioned Conoco rates are effectively going up, right? I think the interest rates in general are going up. And if the rates are going up, how does this actually help or hurt my cash balance or any other plan that I'm eligible for?
Yeah, great question. So on the Heritage plan, so this is the Phillips Heritage, and this individual specifically is a Conoco Heritage employee. If they did not switch over, they would likely have all of their money in the Heritage Conoco plan, which is, as it turns out, the best of all the plans because of that PBGC interest rate that they use for service prior to 2000. So if that individual has 17 years of service, I guess they were hired on after the merger and probably just have the cash balance plan. Also, some changes that happened within the last several years is they allow people to move their cash balance pension assets into the 401k plan, which made sense for some people, didn't make sense for everybody. So you could see there's a lot of moving parts here, and I would probably ask that person call us and schedule a one-on-one conversation so we can get to know their situation a little bit better. But the main thing to remember is that rising interest rates aren't going to immediately impact your cash balance plan, but it will allow your cash balance pension to grow faster because of the interest credit component of that pension formula. but rising interest rates on the Heritage Conical plan will have an immediate negative impact on the lump sum on a quarterly basis, which is how often they update the interest rates based on the 4th month prior to the quarter in which you are commencing your benefit, not necessarily retiring, but starting your pension plan with the company. So hopefully that added a little bit of insight.
Yeah, and I think to wrap things up, because we want to be mindful of everyone's time this afternoon, the reality is of all the companies that we talk to, especially on the oil side, ConocoPhillips has the most dynamic and most threads or veins of different versions of the plan that may or may not be eligible or actually relevant to someone. And so that just points to the significance of making sure that not only you talk to someone who has an idea about these things, but to effectively stress test to make sure you're on track, so that in fact, if you're concerned about market activity or interest rates and so forth, if you're eligible for multiple plans, you might decide to do a different solution from a distribution perspective on each of those plans. So reach out to us. You can do so at 800-900-5867. You can also email us at info@theretirementgroup.com. And with that, we'll leave you for this afternoon. Thank you very much for spending some time with us today. We hope you found value from our discussion, and we'll see you next time. Everyone stay safe.
Thank you, folks.